are things coming up today that I wanted to tell you about that I'm hearing about that are getting me kind of concerned and also raising my little radar popping up here. First of all, Ford Motor Company. All right, Ford has joined DraftKings, and I'm surprised that it's gone this way. Although maybe this has been going on a while, and it is the other way around. But I told you, I think yesterday or the day before, about DraftKings, where they're looking to issue a bond, some convertible notes, bond and notes, senior notes, 1.1 billion they want to issue dollars worth. This is DraftKings. DraftKings wants to issue $1.1 billion in zero interest bonds. Zero interest bonds. Most of the shares of the public company DraftKings are held and controlled by DraftKings people. A minority of the shares that are out there trading are SPAC original investors that created the company in the first place. In any event, it's 6 months later, 8 months later, here we are, fast forward to today, and the stock has been trading around 65 to 72 bucks a share, something like that. And this company, which has only been public for 6-8 months, is announcing a zero interest bond for $1.1 billion. Now, I'm telling you, I'm sitting here talking to you about the SPACs that I like. I've got a group of 6 SPACs I've been talking about. I've been indicating to you that I have a list of SPACs that I like. I have a list of companies that I like that I think these are companies that I think are short, medium, long-term investments that you can make. I'm sitting here going, oh my gosh, we have a company that was merged into a SPAC earlier, like not even a year ago, and it's trading in the $60-$70 range, and now they're offering $1.1 billion of a bond with zero interest. They're not going to pay any interest. They want to borrow your money for 6, 7, 8 years and not pay you a dime for it. And then the kicker is it's convertible, and they're saying it's convertible. And this is why we're not going to pay any interest. You can convert the bond into stock in our company. And I'm thinking, as an old stockbroker kind of guy, I'm going, that's great. Okay, if you have a bond fund, like a mutual fund bond fund that can't buy stock because they're a bond fund, they can buy these bonds from GameStop. Maybe they buy 50 million. This mutual fund buys 50 million. That mutual fund buys 20 million. That one buys 60 million. And you could cobblestone together $1.1 billion from a bunch of bond ETFs and mutual funds, and retirement funds can buy the bond, knowing that you can convert the bond down the road into stock of DraftKings without holding the stock in the meantime. Because if you buy the stock now, you suffer the ups and downs of the market. And if you're a bond fund, you're not allowed to buy stock. That's not in your covenant. You're a bond fund for a reason, right? And as soon as you do convert it, what you'll do is you'll convert into stock, you'll sell the stock, and then you'll buy another bond in something else. That's what bond funds would do. It's not that they can't even convert it. Yes, they can, and then they can liquidate it, and then the fund has this extra cash in it because the hope is that the stock will be trading at a higher price than the conversion. Why else would you convert? And then you sell out the money and put the money into another bond or T-bill or whatever you're going to do with it. Well, I thought, yeah, okay, as an old guy from the 70s and the 80s and the 90s and the 2000s, having been in the business in Canada and having been in the business in Cayman Islands offshore, I thought, oh yeah, well, what's the conversion rate? This sounds pretty good. 90 something bucks a share. It's 40% higher than where the stock is trading at. So I know I'm going, wait a minute, what are you saying to me? You're telling me you want me to give you money and you're not going to give me anything back for it. I lose to inflation. I mean, frankly, I give you $50 million for up to 6 or 7 years, 8 years. And over that time frame, I have to suffer the depreciation of my money because I don't get any interest. And inflation, whether it's only 1 or 2% or whether it's going to 3 or 4%, there's inflation. And so if I don't convert and you give me my money back at the end of the bond term, I get just my original money back. That's now 15% less valuable because it's the year 2026, 27, or 28. But you're offering me the stock option, but it's 40% higher than where it's trading at now. Why would I, as a bond fund, take that deal? And I thought this is a one-off. This is like This is out there. Well, no, apparently not, because this morning Ford Motor comes out and they made it a release. Just read it. Ford is issuing a couple of $1 billion in bonds. Zero interest. They're not offering any interest from Ford. You can buy bonds from us and we'll pay you zero interest, but it's convertible into Ford stock. And if you believe in our car company and you believe in our plan to become manufacturers of electric vehicles like Tesla is already, you can buy into our company and you can convert the bond into our stock. I'm looking at that deal. I'm going, it's a 40% premium for that stock as well. And I'm going, I don't get it. I don't know why a bond fund would care to be in this deal. I just don't see it. I would rather just own the stock directly and the bond fund manager, I'll pass on this deal. That would be my attitude. I'll pass because I'm just not interested in gambling, throwing the dice out there that you guys are going to be successful in the conversion into electric without glitches, without warranty problems, that you're going to be seamless. It's going to be a seamless thing. And knowing that you guys have to sell millions of units of electric vehicles at the profit margins you have to ultimately make a profit. And the hope is that your product, when it's on the road, is a reliable, durable product. I guess I'm going to sit back and say, all right, well, okay, Ford has $2 billion in this bond going out. They might issue more series of these because if they sell out, why wouldn't they? I'd do it. I mean, if I have a corporation going, you mean to tell me I can raise money from people for free? And all I got to do is offer them stock for my treasury at 40% higher than we're trading it? Let me think about this for a nanosecond before I say, yes, I will do this deal. Yeah, sure. Let's do a second series. And then a month later, we'll do a third series. Let's raise $10 billion, $2 billion at a time every month or two. Yeah, why not? Free money against inflation. It's actually, you're giving me money to give it back to you. It's incredible. Yeah, I take that deal. But as a shareholder, I'm going out here, okay, wait, whoa. I own stock in this company. I have votes, theoretically. And I'm the last guy to get paid. The bondholders, even though they don't get interest, they will be paid back first on their principal if the company's ever in trouble before I see anything. So I understand that my company is borrowing money for free, but they are borrowing this money. They're not issuing stock right now, right here, for free. This is free cash too. If they issue stock from the treasury, you don't have to pay interest on any stock you issue from the treasury. That's free money as far as interest rates go. You're diluting the company, but you know what? The company is raising cash. It doesn't ever have to pay back. It's not on the books as an IOU or a liability. Where a bond, you issue a bond that you owe that money. Maybe it didn't cost you money to rent the money. It's not costing you anything to rent it, but you got to bring it back with in the cash format. Again, I've never seen this in my career, because when I started as a broker in '79, a car loan was 15%. Now here we are today with 1.75% interest rates, and the market is freaking out. It makes us old timers laugh because we're going, you kids, you have no idea what inflation really is. You have no idea what interest rates are. You don't know. But it's all right. It's all right. We're all in the world we're in.